One of the best investments I've ever made in my early days generated a 25% annualized return and had relatively low risk. It also allowed my family to save significantly without sacrificing our lifestyle. So, if you're curious to know what it was and if it's right for you, please stay till the end. Hi, I'm Prudence Zhu, CPA and financial planner. I came to the US in 2012 with very few belongings and became financially secure in 9 years. Today, I will share my case for owning a multifamily home, considerations before investing, and the tax implications of owning investment real estate. I have to say that the content of this channel is for education and entertainment and should not be considered financial or investment advice. Past performances do not guarantee future returns, and to make the best financial decisions that suit your needs, you must conduct your research and seek unbiased advice from a certified financial planner. Now, let's get to it. Our first real estate investment was a multifamily home in the Wicker Park neighborhood in Chicago. If you know a little bit about the city, it's one of the most sought-after areas to live in Chicago. It's a historic area with landmark buildings, countless bars, trendy restaurants, cozy coffee shops, art galleries, and retail stores. It's also close to the Blue Line and only 4 stops to downtown, where I worked. It was perfect, and it turned out to be one of our best investments. I compared the owner and the renter's situation by extrapolating actual data. Both Prudence and Ryan started with $140,000. Prudence used it to purchase a 2-flat building for $700,000 with 20% down. She had a good credit score and wanted to invest in real estate. The building had 2 3-bed, 1-bath apartments with a rent price of $2,400 per month each, and the mortgage was around $3,400, including interest, principal, and escrow for property tax and insurance. As a result, Prudence's monthly housing cost was only $1,000, which was the mortgage payment net of rental income. And she puts away the monthly savings of $1,400 into a low-cost, well-diversified index fund. On the other hand, Ryan invested his money in the stock market in the same manner. But paying $2,400 per month on rent, he had nothing left to invest in addition. I use the average of 2.9% growth for real estate appreciation and 10% for the stock market. Fast forward 4 years. Prudence's total asset in the stock market and the home equity would grow to representing an annualized return of 25% over the initial $140,000 she had. On the other hand, Ryan would have $209,000 in the stock market with a 10% year-over-year growth. Owner Prudence was able to realize above-market return from owning an owner-occupied multifamily home, thanks to correct leveraging, compounded return, and time. If you're still not bored, I'll share the link to the complete model in the description below so that you can follow my calculation after the video. Let me explain the significance of the difference between 25% and 10% annualized return if it doesn't seem a lot to you. Pure hypothetically, if Prudence and Ryan both kept growing their money at the same rate they did in the first 4 years, owner Prudence would have $3.3 million in assets at the end of year 14, whereas renter Ryan would only have $0.6 million. Now let's get on a more strategic level to review owner-occupied property as investment. There are many benefits. First of all, favorable terms of financing. One of the most significant benefits of owner-occupied multifamily home is the ability to get better terms on financing. You'd get lower interest rate, need less down payment, and less demanding personal guarantees compared to a pure investment property. Because in the eyes of the mortgage lenders, the owner-occupied property is lower risk than investment property. If the owner lives in there, they would probably maintain the property much better. Second, quick start on real estate investing. If you follow the route of buying a primary residence and then saving for the 25% down payment for an investment property, it might take years before you can own an investment property that generates positive cash flow. And since owner-occupied multifamily homes enjoy many financing benefits of a single-family home, you'd be able to afford it and start investing much earlier. Third, offset on mortgage costs. As we discussed in the case, your net mortgage cost would be significantly decreased with rental income from the rental unit. And if you have the good habit of putting away the savings and investing, you'd shorten your path to your first $1 million in net worth by a few years. Fourth, it's an easy way to test whether landlord life is for you. Real estate investing is a big commitment because the transaction cost is high, it requires upkeeping and in most cases, active management. And it's a lot less liquid than other financial assets such as mutual funds and stocks. So, it's a good idea to test if being a landlord is what you want before you commit to higher stake properties. And for my family, after 4 years, we realized that it was not for us. And we were glad that we didn't have to take care of more properties than we wanted. So, is an owner-occupied family home a good investment for you? I won't be able to tell without knowing your specific needs and options. What worked for me may not work for you. So here are some considerations to get you started. First, location. You need to weigh the property's location heavily in your investment decision. It directly impacts the appreciation potential and cash flow, since the properties in more desirable locations are easier to sell and would have a lower vacancy rate when rented out. Second, you need to consider your cash flow, since owning a sophisticated property has many potential risks. For example, would you be able to afford a major repair if the heating or cooling system suddenly stops working? Would you be able to pay the mortgage if the rental unit fails to rent out for a couple of months or even more? Do you foresee any urgent need, usually a large sum of money, where you would have to liquidate your real estate property even with a significant discount? And the list goes on. Third, the lifestyle of owning versus renting is very different. And it gets even more complicated if the landlord lives under the same roof as the tenant. If you're renting, you can call the landlord if something breaks down and expect it to be fixed quickly. But if you are the landlord, you will need to fix the problem or go through the entire process of requesting quotes, coordinating and supervising the repair, and paying for it. In addition, I can't tell you how often I got annoyed by all kinds of noises my tenant was making but couldn't complain because I didn't want to ruin the relationship. Fourth, management cost. If you want to avoid the hassle of managing your tenant and the property, there's a solution: hiring a property manager. It would make the life of a landlord significantly better, but it comes at a cost. There's usually a monthly management fee, commission for finding new tenants, and maintenance and repair charges for material and labor. It may eat away a lot of your positive cash flow, or even wipe it entirely out. However, investment properties provide rental income, increased property equity if you keep paying the mortgage, and in most cases, appreciating property value. So, at the end of the day, it may still be a wise decision to include a good property manager as part of your investment plan. And here comes the most exciting part: the tax implications of rental real estate. I also get a lot of questions from my clients about it. Let's talk about the income part first. If the property is your primary home and you rent it out for fewer than 15 days during the year, you don't need to report the rental income. If you rent it out for 15 days or more, you must report the rental income on Schedule E of your tax return. And on the loss side, if you use the place for more than 14 days or more than 10% of the number of days it is rented out, whichever is greater, it is considered a personal residence. So then, you can only deduct the rental expense up to the level of rental income, meaning you cannot deduct any losses. But if the personal use is less than 15 days, then there are 3 possibilities to deduct your rental real estate losses. If you are a real estate professional, meaning you spend more than 750 hours on qualified real estate activities, and it accounts for more than half of your total working hours in all trades and businesses, and keep proper documentation, then you can deduct losses against any other type of income without limitation. If you are an active investor, meaning you make decisions about the rental real estate and have proper documentation, and if your adjusted gross income is $100,000 or less, then you can take up to $25,000 of rental real estate losses against any other type of income. But most people don't qualify for either, in which case you can only use the rental loss to offset passive income. And if you don't have any in the year the loss occurs, it gets suspended until you have a passive income. For example, when you sell the property at a price higher than its tax basis. To sum up, owner-occupied multifamily homes could potentially generate greater than the market return, which might be very helpful in your early wealth accumulation days. But you should first consider the location, risks to your cash flow, and the lifestyle of a landlord living in the exact location as your tenant, and the potential management cost down the road. In our next episode, I'll tell you a $1 million decision all new parents would face. So stay tuned. I hope today's episode was helpful. If you liked it, please give it a thumbs up and share it with others. We are also available on your favorite podcast platform under Invest with Prudence. Please subscribe to my channel if you want to learn more strategies to build your financial success. See you next time!